So what does a recession do to the housing market? Sometimes it seems like headlines do more to terrify than clarify. Glancing at headlines such as "a recession is coming" or "recession vibes are strong" could leave one to think the worst, but the truth is a typical recession isn't like the recession we had back in 2007, 2008. Ever since then, the word recession instilled a lot of fear in our minds. The 2007, 2008 housing market crash caused a lot of pain with loved ones losing their homes, their jobs, and it also left a lot of people, in financial ruins. Home prices plummeted, a record high of number of foreclosures, and big banks were all bailed out, so on and so forth. It was a real mess caused by subprime lending, or in other words, banks giving mortgages to people who didn't really qualify for the loan in the first place. Since the 2007-2008 crash, laws were made to prevent this type of reckless lending again. So now when a recession does happen, it hopefully won't be because of a huge housing and market crash because of subprime lending. Well, unless possibly new laws are made to take money from people with low risk loans with good credit and 15 to 20% down to give out to more high risk loans to people with bad credit and who really shouldn't be getting the loan to begin with. Wait a minute. I think they just passed a law like that. But that's a whole nother story. Anyway, with that said, Bankrate wrote this: during a traditional recession, the Fed will usually lower interest rates. This creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunities for home buyers. So, what does a recession mean to the housing market? Well, this graph shows a recession does not mean falling home prices. In fact, this graph shows that during the last 6 recessions, home prices typically have gone up, other than the 2008 housing market crash. In addition, a recession means falling mortgage rates. The second graph shows mortgage rates have gone down during each of the last 6 recessions. And as you know, lower interest rates mean there will be more buyers in the market. Currently, Americans are sitting on a tremendous amount of equity. 68.1% have paid off their mortgage or have at least 50% equity in their home. As you can see from this chart, the blue piece of this pie shows that 29.4% of homeowners have greater than 50% equity. The orange shows 31.9% have less than 50% equity. And in green, 38.7% of homeowners own their home free and clear. Some people ask me, why is there's still such a short supply of homes on the market? Shouldn't there be more homes since the interest rates are higher, which would make less buyers in the market? Typically, the answer would be yes, but since mortgage rates have been rising at what seems to be a record pace, I think homeowners are sitting back and just enjoying the low mortgage rates they have gotten over the past decade or decade and a half. This chart shows the current rate of existing mortgages in Q4 of 22. All right, the red bar shows that over 80% of homeowners are at or below 5% on their existing mortgage, and over 50% are below 4%. So it is going to take a lot to motivate someone to, move when they have these low interest rates, which I feel is one of the main reasons homeowners are deciding to not sell and stay put in their homes. The bottom line is that historically, a recession doesn't mean a housing crash. America still has little supply of homes to meet the demand, and right now mortgage rates are what we need to keep an eye on. I'm Tony Guerin with RE/MAX Select Professionals, Guarantee.com, results that move you. I want to thank you for watching this video. I'll see you around. Take care.